Let me put up our notes again. All right, what is key for us? I think the last class we went on about trying to define some terminologies, and in retrospect, I think we went a little bit deep into the tax element of things. But let me just quickly remind us that this is corporate reporting, and so therefore, anything that will have to do with tax treatment, be rest assured, and when I say tax treatment, I mean what will be done in order to get your taxable profit or tax loss. The examiner would have to mention. The examiner will not rely on your knowledge of advanced tax. So whether I have done tax or advanced tax does not matter so much. Only that if I have knowledge of that, I can easily understand what is being said as regards expenses being non-taxable. I said non-taxable, non-deductible, or incomes being non-taxable or taxable. All right. So that's, I can understand that because I have done much more detailed work with regards to that in advanced taxation or taxation, those two papers. Now, when we come to income tax and we're dealing with it in financial reporting or corporate reporting, I said there are two major categories. And what are those two major categories? We would have current tax and deferred tax. Now, your current tax, we understood from the last class that it is referring to any present tax obligation that you may have now. Any present tax obligation. Now, it could be accruing from previous period. You would realize that at some point we solved a very simple example where we looked at underpayment of tax and overpayment of tax. And what we said is that if you have underpaid in a prior period, IAS 12 is saying don't go back and do any other thing than in the current period, recognize that tax liability in your current tax expense. Use it to
Your line is cracking up.
liability. There is no two ways about that. All right. The network threw me off, but I'm back on. Let me get back to what I was saying. So I was talking about where you have overpayment, and I said that the standard I just wanted to be sure I'm still on. All right, good. Now, the standard says in the case of overpayment, if you made an overpayment in the prior period, you are allowed to treat it as a tax asset. However, from what we both looked at in the last class, we said what is very common in practice is that you will just use that you will just debit that overpayment to your current tax liability. You debit it, meaning that what you have done is you have simply offset. And I said in that class that IAS 12 allows this offsetting. But it is not really IAS 12 that is really allowing it per se. It is just that it is in line with IAS 1, the rules for offsetting. which is that if I'm going to offset, is the pattern of my payment or settlement of my liability and the recovery or the receiving of my receivable or the recoverable or recoverability of the asset, are they patterned together such a way that it is a net settlement basis? If it is a net settlement basis, it means that I can go ahead in my accounting treatment to offset. I can go ahead and offset. It's very simple and direct. All right. So it means that what we did in the last class to say if there's an overpayment, I can go ahead and debit my current tax liability and by debiting this tax liability, what I have done is I have used my overpayment to do what? To reduce. Remember, I had previously credited bank. So that excess, and I discovered that what I paid and credited to bank was an excess. So the debit leg of that excess is what I'm debiting to current tax liability. I would not need to do a double entry per se. I'm just deducting. But if I want to recognize the asset, I would have to go ahead and say, you know what? I am going to debit my current tax assets and then I'm going to credit tax expense, which is me saying that I am reducing my expense with this asset. Whichever one you do is okay. Now, I have said it in the last class, the current tax the current tax element of IAS 12 is not so much of a problem, If I am given an examination question, most likely for CR, what you are likely to be tested in is deferred tax. And then you are most likely not to get, what you will likely get will be something related to carrying amount of assets that are not so popular, but they may decide to come down to PPE again and still test deferred tax in terms of PPE. Whichever one is fine. But let's move on. Now, in terms of how do I even go about current tax? My current tax, I simply look at my taxable. If I want to determine what is the tax base or what is my taxable profit, I know that all I need to do is to consider what are items that I had previously deducted from my income in the form of expenses. What are those expenses that examiner is now telling me that, oh, for tax purposes, this will not be deductible. So what do? I add them back. A very good example is my accounting depreciation. We did it in the last class. What did we do? We added back the accounting depreciation. Instead, in the place of the accounting depreciation, what is allowed is capital allowance, or what you can also call tax depreciation. And that was what we deducted instead. All right. But in some instances, they will tell you explicitly this expense is not allowable for the purpose of tax. So if they tell me that, I know I'm going to have to add back that expense to get my taxable profit. However, they could also tell me that I have an income, and as a result of the fact that that income is not taxable for different reasons, if they tell me that it is explicitly not taxable, that income cannot be or should not be taxed according to the tax laws, what I'm going to do is I'm going to make a deduction of that income. I had earlier added it, but now I've been told it is not going to form part of my taxable profit. I'll go ahead and deduct. All right. Now that's a little bit different from what you have when we get to deferred tax. So that sort of handles current tax. Not so much of a problem. However, permit me to just share with you the same screen based on what we did. And that's if I have not tampered with it because of FR student. No problem. Let me see if I have it up. The Excel we used, I think I still have it up. So what I want to talk about now is deferred tax. All right. Now, I said deferred tax. I kept repeating it. I don't know, maybe that it was your class or FR. I was making that emphasis. I think it was FR. I kept repeating it. That deferred tax, unlike your current tax, one of the major difference between your deferred tax and your current tax. Current tax is speaking to your tax obligation, what we will expect to pay, what is probable that we will pay. All right. Now, your deferred tax is not a tax that you have been asked to pay. What you are only doing with deferred tax is that you are making an accrual for tax that you may have to pay, you will likely have to pay in the future with regards to transactions that had occurred in the current period. So we have transactions that have occurred in this current period for which we are either paying a small amount or no amount at all, for which we expect that certain events will occur in the future that will trigger us to pay more. Now, let me give an example so that I can give context and you can understand. We made an example of incomes when the tax authority says, I am only going to tax this income on cash basis. So we said the carrying amount of the asset will include, of the receivable, which is the asset, will include the accruals of even the incomes you have not received. All right. It will include even incomes that we are yet to receive. So therefore, when tax authority says I will do cash basis, it means that what they are going to consider or what they are going to attribute, the amount they will attribute for tax purposes, which is what you call tax base, is going to be different from the carrying amount of the asset. So that you can understand what I'm saying. We are saying we have a receivable. Now, that receivable is, let's say, 5,000. Now, the other leg of receivable is, in this case, is sales. So when they want to tax sales, the reference to that sales will be in two ways. The ones that we have received cash for, cash sales, and then we have another bit that we have not received cash for. So the authority says, I am only going to tax the bit that I have what? Received cash for. In the current period, I have a receivable of 5,000. That is the carrying amount of this asset. When tax authority comes, they will say tax base is new in respect of this receivable. Why? Because I have not received cash yet. So therefore, in this period, they will not tax this 5,000. However, I know that I will receive, if not even all, it is probable that I'm going to receive. I have made the judgment. If I was not even going to receive all, I would have made a provision for it anyway. I have now made a decision. I have come to the judgment that I am going to receive this 5,000. If I have not received it in the current period, I'm going to receive it in the following period. So therefore, when they come in the following year, this receivable will no longer be a receivable. It will now have been cash. It will now have become a cash sales. All right. And it will now be taxed in that following year. So common sense now says, you know what? They have not taxed it now, but they are likely going to tax it in the coming year. So therefore, let me recognize an accrual for how much I will likely pay for this receivable of 5,000. So I now said, When this occurs, when the carrying amount is not equal to the tax base, that is, the tax base, what they will consider for tax purposes is 0 in this case, the carrying amount of the asset receivable is 5,000. What you have here is a case where we will have temporary difference. Temporary differences occur because the tax base is different from the carrying amount. And now, we now went further to say it will be a taxable temporary difference if in any period the carrying amount is greater than the tax base. It means that the carrying amount, the tax base for now, what they have considered for tax now is a lower amount than the carrying amount of the assets. So therefore, in the future, we can make a provision that we will have to pay this tax in the future. All right. Now, if that is the case, should that be the case, then we may expect to pay a tax in the future. And that is what we did here to say, okay, the cost of an item of the asset is 1.5. For the purpose of tax, tax authority says tax depreciation is 900. The tax base that will be considered for tax basis is 600. However, the carrying amount, because of accounting depreciation, the carrying amount is still 1,000. So what do? We have a case here, carrying amount is greater than tax base. Should that be the case, I said there should be taxable temporary. So you go ahead and use your tax rate. It says tax rate multiplied by the temporary difference, and that will give you the deferred tax liability. All right, and that is that on taxable temporary difference. Now, temporary difference do not only occur when carrying amount is greater than tax base, it could also occur when the tax base is higher than the carrying amount. And this will usually happen with respect to some liabilities as well. So you could have a deductible temporary difference. Now, when you have a deductible, when you have tax base greater than carrying amount, that is when you have a deductible temporary difference, meaning that in the future, we are likely going to be able to reduce our tax liability because we are being taxed more now. We are being taxed more now. An event will occur in the future when, in respect of this transaction, we will not be taxed. All right. So therefore, we now recognize a deferred tax asset. As far as deferred tax asset goes, we have said it in the last class as well, that you should be careful that you must ensure that recoverability is key in IFRS as a whole. When we recognize assets, if any one of us are in the financial reporting team of our places of work, you will notice that the trouble you have with auditors is usually with impairment and stuff like that, because they want to test. You say you have receivable. Are you sure that you are going to be able to recover this much? So therefore, let's introduce the concept of IFRS 9 and impair your receivable. Do you understand what I'm saying now? So it's the same thing when you want to recognize deferred tax assets. You apply the concept of recoverability. Will this asset be able to, in the future, is it probable that it will reduce my tax liability? If it is probable, you may go ahead. Now, the deferred tax assets don't only occur. Let me take you back to the note so that you quickly remember this one. Deferred tax assets do not only occur because of deductible temporary difference. It may also happen because of unused tax losses. It may also happen because you have some allowance to be able to use your tax losses to reduce your tax liability. You can see it right here. It's right here. You might be able to, you have carried forward unused tax losses. If you have unused tax losses that you have not, it means loss relief. You have not used it to relieve your tax liabilities, your tax paid in the previous year or future tax liabilities, then we will also have a deferred tax asset. We also have a deferred tax asset when you have tax credit that you have not used. And I gave a very practical example in that class. We talked about withholding credits. When you have withholding tax credits, you may also have them unused if the law of the land allows you to carry forward any unused withholding. Go into that year saying, oh, I'm supposed to pay this, so I can use it because it is probable and the tax law allows it. Then I can go ahead and recognize that deferred tax asset. All right. Now, so that is just to brush us up on what we have done in terms of current tax and deferred tax. Now, also, I'm sure I made mention of it, that when you estimate your deferred tax, what goes to your P&L, your income tax, is the movement of the deferred tax, meaning that my current tax, or let me put it like this, my income tax expense will be made up of two things. It will be the current tax and the movement of the deferred tax. These are the two things that will make up what goes into my, what is it called now? Into my statement of profit or loss and OCI. What will go there in the respect of tax will be the current tax expense and the movement of the deferred tax expense, right? So you must note that your current tax expense plus the movement of the deferred tax. All right. So let's get into it. Let's look at questions and see how we can go about solving them, because that is my real aim for this session, is for us to just consider questions. And I've combined both FR and CR. Your own aspect of the question is not so much. Let's see. Okay, this is Word document. Let me look at the PDF version of it. All right. So I just want to ask, do we have any question from what we have said so far as regards IAS 12? Now, for your class, even for FR, but more so for CR, for your CR, I cannot overstretch the importance of IAS 12, because if you're going to be solving published accounts, it is almost unavoidable that you're going to have deferred tax as part of the question. Now, because they are not testing it separately as a 20 marks question, it may not be as cumbersome, but you will still require the knowledge of deferred tax and or more generally income tax, so that you can apply both the current tax and the deferred tax to your solution. All right. Okay, let's get into it. So question 1, we're looking at a question from May 2024. It said below is the statement of financial position extract of Bamboo PLC, which has a number of subsidiaries in all the geographical zones of the country and one foreign subsidiary, Paco Limited, located in the United States of America. All right. And first thing I'm seeing there, under assets, I'm seeing deferred tax asset of 77. I will assume it's Naira. And I'm also seeing deferred tax liabilities. I can see that as well. All right. What I have not seen is their current tax. But let's move on. Now we're told Mr. Agbaje, the finance director of the Bamboo PLC, is in the process of preparing the final draft of the financial statements and the following issues relating to the treatment of deferred tax implications arose. All right. Number one, property, plant, and equipment. We're told on November 1, 2022, Bamboo PLC purchased an item of property, plant, and equipment for 120 million naira, which qualified for a government capital grant of 20 million naira. All right. Immediately I see government capital grant. What should come to my head is IAS 20. However, let's see where they are going with this. Okay, before I even go there, I like to first of all see where they are going. Where they are going, like I always advise, just look at where they are going first of all. They are asking us to briefly explain and show necessary calculations, if any, of the deferred tax implications for each of the transactions in I to III above 15 marks. And then they say show the deferred tax effect on the draft statement of financial position of Bamboo. The requirement looks simple. Let's go back to it. They want us to just explain accounting treatment. And that's a very common feature of CR. The test standards ask you to show, you don't have to write all the stories in the world. What they're asking you for, how do we come down to the amount we are going to debit and credit, and show them the debit and credit? You have answered that question. Let's move on. All right. We're told that the cost of the purchased an item of property, plant, and equipment for 120 million naira, which qualified for a government capital grant of 20 million naira. So government must have awarded them 20 million naira because they qualify. They met the condition to receive the grant. Now, what will be left is how they are going to treat that grant. I'm sure Mr. Wasi would have done IAS 20 with you. You either treat it as deferred income and you continue to now prorate it year on year in line with how you are also depreciating the asset, or you can just go ahead and simply deduct this 20 million from this 120 million. All right. So by doing that, you will be spreading over 100 million. All right, let's move ahead. The asset has a useful life of 5 years and is depreciated on straight line basis. Now, capital allowances are restricted by the amount of grants by Federal Inland Revenue Services, FIRS. The company income tax laws specifies a capital allowance rate of 25% per annum. Now, let me go back to this part of the question. Here we've been told depreciation, I'm sure that's accounting depreciation, is done over 5 years, all right? But then we have been told that capital allowances are restricted by the amount of grant by FIRS, meaning that when they will come and look at this asset, yeah, it is true that the cost of the asset is 120 million naira. But FIRS will not look at 120 million naira. They are going to say that you have received a grant of 20 million naira in respect of the same asset. So they are going to restrict their capital allowance by that to that amount, meaning that they also will not look at 120 million. They will first of all deduct the grant that you have received. All right. And now that makes it easier to solve this question. Now, to solve this question, all that we are going to need to do, because this one is quite easy, I think I can solve here, is to say, in terms of tax depreciation, what are you going to have? I will have 120 million minus 20 million divided by, they said 25%. Tax rate, capital allowance rate is 25%. So what I would do here, let me erase this line. What I would do here is to say this in bracket multiplied by 25%. Now we all know that 120 minus 20 is 100, multiplied by 25%, that should give us 25 million naira. All right, the capital allowance or tax depreciation that will be recognized on a yearly basis is 25 million. However, the accounting depreciation, I am going to assume that they have chosen so that my solution is quite straightforward. I'm going to assume that they have chosen to use the asset method, which is to deduct that capital grant from the cost of the asset before depreciating. The two of them is the same anyway. So what I would do is I'll say 120 million minus 20 million naira divided by, they said they have so determined that it has 5 years useful life, 5, and that will lead us to how much? 20 million naira. So I can see from here that the effect of this is that at the end of the day, my tax base, I would have reduced 100 million. My tax base, I would have reduced. Okay, let me just go ahead and do it on the Excel so that it is spelled out better. Where is it? Okay.
I can't see your screen.
What did you say? Can you see my screen now?
Yes, sir.
All right, good. So more or less, I'm saying with respect to PP.
Sorry, sir. I thought the asset is for 5 years. Why are we timesing it by 5%?
25%. Okay,
Yes.
I'll come back to you. Okay, I'll come back to you now. So accounting depreciation, no problem. It's for 5 years. We know that. I said you will say, Shebi costs is 120 million. All right. Grants that you were given is 20 million. I am now saying for the purpose of depreciation, we are allowed by IAS 20 to do this, to say 120 minus 20. All right, we can do this, meaning that what we are saying is that we received 20 million. I don't want to overflow this one. 20 million bank, Abi, and then we credit asset, PPE, by that same 20 million. So when we want to calculate depreciation, we'll calculate depreciation based on this 100 million. Now, my accounting depreciation will therefore now be equals to this 100 million divided by the 5 years, which is 20 million. All right. Now, but when it comes to my tax depreciation, for the purpose of tax depreciation, I have been told two things. What are the two things I have been told? First one, they told me that the capital allowance rate is how much? 25%. Number two, they said I will restrict capital allowance by this grant, all right? Meaning that when I restrict this, what I will consider as the cost will be equal to 100 million. Why? Because I have restricted the capital grant. Is this understood? Is this understood? I'm asking the person that asked the question, is it clear? It's clear, Madam Abidemi, is clear. But who asked the question? I hope you understand what I'm saying here. So the reason we use 25% is that for the purpose of capital allowance or tax depreciation, whichever you prefer, government has chosen 25%, which is inevitably saying that they are going to spread it over 4 years. So the tax depreciation will be this 100 multiplied by 25%. And this will be the tax depreciation. All right. So now what does this mean? What does this mean? The carrying amount of the asset at the end of 2022 will be equals to this 100, all right, minus the yearly depreciation we have calculated, which is 80. Now, for the purpose of tax, the tax base, taxman will say, I am recognizing 100, and the yearly depreciation for 4 years is 25. So therefore, our carrying amount is higher than the tax base as a result of that. So therefore, we have, I said, whenever the carrying amount is higher than the tax base, you have a taxable temporary difference. So our taxable temporary difference is equal to this difference here, 80 minus 75. All right. Now we'll apply the tax rate to get the deferred tax liability. And the tax rate is how much? They told us, I think they said 30%. So I'll say 5 multiplied by 0.3 or 30%. And that will give me 1.5 million. All right. All of this is in Naira million. All right. So this is the amount in respect of this. But they're asking us for the accounting treatment. Is that not what they asked for? Let me read the requirement. It says briefly explain and show necessary calculation, if necessary, of the tax, of the deferred tax implication for each transaction. All right, so my explanation is very simple. I'm going to tell them that since there is a restriction for the purpose of calculating this tax depreciation to the amount of the capital grant, I am going to reduce that 120 by the 20 million. All right, that is the reason for that one. Tax law affects tax base. That is the reason I used 100 for the purpose of tax depreciation. For accounting purpose, carrying amount, we will reduce it by 20 million because IAS 20 so allows it. That if I have received a grant in respect of an asset, I can make the deduction against the cost of the asset and recognize the net amount as the cost of the asset in my books. All right. All right. Now, If I have done that, my accounting depreciation on a yearly basis will be 20. Somebody may now say, why did you assume that we're going to deduct straight? Even if you don't deduct straight, what would you have done? You'd have said 120 divided by 5, all right? And that would have given you 60, isn't it? I said 60, 20 divided by 5, sorry, 24. Now, don't forget that you have a 20 in your deferred income that you are going to be recognizing year on year in your expense. If you do that one, you say 20 divided by 5. On a yearly basis, you will be taking to your expense 4 million. The net amount is still going to be 20 million. So your accounting depreciation, and if you do it this way, have the same effect. Either you expense 20 million on a yearly basis with respect to this asset, or you go ahead and depreciate it by, you go and recognize 24 as depreciation, but then you will now recognize this income of 4 million, which is the spread of that 20 million you received over 5 years. So you recognize income of 4 million, expense of 24. The net effect is still expense of 20. It's the same thing. All right. So not to overflog it, I'll move on, except there's question. All right. If there's no question, I move on to fair value adjustment. On November 1, 2022, Bamboo PLC acquired the wholly owned subsidiary, Iroko Limited, for 100 million naira. On that date, the fair value of Iroko Limited net assets, the net asset was 80 million and carrying amount was 70 million, which is also the tax base under income tax law. The difference between the fair value and book value of the net asset relates to an item of PPE, which Iroko currently has no plan to sell. Iroko presently have no plan to sell. Okay, for this transaction, what do you do? All right. Now we have fair value adjustment. Now, remember, they told us that historically, the net asset was 70 million, was 70. But now there is a fair value adjustment, which is going to cause the carrying amount to increase to how much? To 80. So this will be the carrying amount now, no longer 70. So carrying amount is now 80. However, the same question said the tax base is 70. So the tax base was the same as the former carrying amount, but not any longer. So in this case again, carrying amount is higher than tax base. If this should this be the case, I said you are going to have a taxable temporary difference, all right? And the temporary difference there is 10. So I'm also going to apply tax rate of 30%. And that will give me 3 million naira, all right? Okay, let's move on. Profit from foreign subsidiary. Profit from foreign subsidiary. Pay attention here. Pay attention here because I'll do more explanations here than workings. Paco Limited, a wholly owned foreign subsidiary of Bamboo PLC, has undistributed post-acquisition profit of $5,000, which would give rise to additional tax payable of 4 million naira if those profits were to be remitted to Bamboo PLC in Nigeria. All right. Paco Limited is relatively new and a rapidly expanding company. Bamboo PLC intends to leave the earnings with PACO Limited for reinvestment. All right. Now, briefly explain and show necessary calculations. Okay, we've already read that part all over again. All right. Now, it would have been straightforward if we didn't have this clause there. That first of all, PACO Limited is fully owned by Bamboo, meaning that they can exercise the rights to instruct PACO Limited whether to pay or to retain that profit. All right, number one. Number two is that if they can ask them to reinvest, remember that if they reinvest that profit may either turn around to cause more profit for them, it may turn around and it could even lead to losses. So it is not probable that this profit of $5,000 by the time we come in the future will remain. So if it is not taxable now, if the clause for it to be taxable is when PACO Limited remits it to Bamboo PLC. As far as the current year goes, number one, as far as the current year goes, they cannot tax them 4 million naira. FRS will not be able to tax them that 4 million naira because they have not received that profit. All right, it has not been received. If they are going to receive it, they will receive it in the form of dividend. Don't forget, they will receive it in the form of dividend, and dividend will be taxed on cash basis. That is why they said if they were to remit it, meaning that if they were to pay that cash to Bamboo PLC. Now, they have not done that. So therefore, even in the current, no tax. Now, what is the probability that they will be taxed in the future? Look at the nature of what we are talking about, a bottom line that is going to be reinvested, the bottom line of a foreign subsidiary being reinvested. Now, if it is to be reinvested, like I mentioned earlier, you know that it is possible they may have loss in the following year. It is possible they may have less profit amount in the following year. It is possible they may have the same amount. It is possible they may have a higher amount. So it is hard to estimate that this is going to be the profit they will come back with. All of that is what you are going to explain as why there will be, in respect of foreign subsidiary, there is no deferred tax. No deferred tax. No deferred tax. No deferred tax will be recognized. Even looking at it from the aspect of the group, even if they go ahead and increase their retained earnings with that profit, that element of that dividend will, for instance, there is no deferred tax. If you go, I recommend that you go ahead and look at the solution as well. This is CR May 24, question 3. Go ahead and look at the solution itself. Now, where we disagree is maybe it was an omission on their part anyway, to be fair to them. We have 2 adjustments. The other part said we should show the drafts having affected. Wow. It didn't come together well. Anyway, this is what I'm going to do for this one. What have we done so far? Remember I told you, if it is a deferred tax liability, it should increase the deferred tax liability, all right? So that deferred tax liability line this deferred tax liability line, we have had two adjustments. There is one of 3 million and there's another one of 1.5 million. So what you would do is to increase deferred tax liabilities by that amount. How much did they say it is? They say it's 186. So I'll just say plus 3 plus 1.5. In their solution, I feel they omitted this one. And then my retained earnings will be debited. I am crediting this and debiting my retained earnings. Why? This expense, what I have just calculated, would increase our income tax expense. If it increases our income tax expense, then it definitely would reduce our retained earnings. What is our retained earnings? 620. So I'm going to reduce that 620 with the 3 million and then with the 1.5. All right. So this is it. These are the two numbers that will change on the draft statement of financial position. And that is it. I think they were reasonable here. They gave it 20 marks. Can I move on? Can I move on?
Probably when I go through it again.
Which part gives you which part is
Okay, you were like you explained deferred asset and deferred liability. You said if it's deductible temporary difference, that means your tax base is greater than your carrying amount. So what about
of course
if it's the other way around? I really don't understand it.
When you say the other,
as in, I really don't understand.
I'm
unable to identify. I get it when it's taxable temporary difference. That's when your carrying amount is greater than your tax base. Is that an asset or a liability?
Which one?
The one I just mentioned now.
Okay, that will lead you to a tax liability, deferred tax liability. And you know why? Okay. Because you are saying that it's taxable in the future. When you say deductible in the deductible temporary difference, it means you are saying that you would have the opportunity to reduce your tax liability in the future. So that deductible or deduction, that deduction is to reduce. Remember, tax on its own ordinarily is usually a liability. So when they say deductible, what they are trying to say is that I can use it to reduce, or there's a tendency, it's probable that it will reduce my tax liability in the future. Do you understand now?
Yes, I now understand. So what about if it's that deductible tax liability, is it a deferred asset? Can we call it a deferred asset? A deferred tax
exactly asset? That's what it is. That's exactly. So if you maybe just for recapping sake, let me just recap again. I said there are 3 things I showed you in that what is it called now? That material. I said there are 3 things that can give you your deferred tax assets. All right. One of them is relating to temporary difference, deductible. When you have a deductible when you have a deductible temporary difference. Number 2, when you have carried forward unused losses, unused tax losses. If the tax law permits loss relief over a number of years, and you have tax losses that you have not fully used, and you still have a number of years to use it. In those number of years, what you'll be doing is you'll be carrying it forward. All right. Some of us, if there's any one of us who is in tax practice, will understand this better. When they calculate your deferred tax, that's what they do. Okay, I can see your question. What make up 190.5? I'll go back to that. If you have unused tax credits as well, if you have tax credits that are unused, you could also have the same situation. So these are the 3 things that we're speaking about in that lecture that can lead you to deferred tax assets. All right. Now, as regard your question here, if you look at my workings here, the deferred tax liability in the question, the original question, in that draft, the deferred tax liability was 186. This 186 right here. So what I have done is simply to add these 3 and this 1.5. We have taxable temporary difference, meaning that we have deferred tax liabilities of 1.5 and 3 million. I simply added that. Now, I said the effect of these expenses is that they reduce your retained earnings. And that was why I deducted. So the original amount was 620, and then I deducted this 3 and this 1.5. All right, that's that on that. Any other question? In the absence of any, I'll move on. Now let's move on to the next. I have another CR question here. It's only part of the question. This was tested May 2023 as part of a 20 marks question. We're told Omoge Nigeria PLC has the following share option scheme for its directors as of May 31st, 2021. Now we're giving the name of the directors, the grant date, and the options that were granted, that is the number of shares, and the fair value of options at grant date, meaning that
Sorry,
these values.
can you share the questions? The question, please.
I have already shared the question. It's on the group.
Oh, okay.
Or do you want me to screen grab it for you? Is that what you're saying?
I just wanted to read along as you are reading. I'll take it from.
It's on the group. All right. So we're giving the options granted. That's the number of shares. If they exercise that option, they will have Adamu Salisu would have 400,000 shares. Chukwu Eze would have 1.2 million shares. Now, the fair value of options and the grant date also determined to be 3 and 2.5. The exercise price is 4 naira and 5 naira respectively. And the vesting date, June 2021, June 2023. Now, the price of the company's shares as at May 31st, 2021 is 8 naira per share, and May 31st, 2020 is 8 naira 50 kobo. The directors must be working for Omoge Nigeria PLC on the vesting dates in order for the option to vest. So what we have read so far, I think I saw it when Mr. Wasu shared something on IFRS 2, one of your early topics you must have treated with. IFRS 2 share-based payment. For your examination, you have to know. So what I would advise you to do is this: write out all the relevant standards. If I were you, that's what I would do. Write out all the relevant standards. Write it out and ask yourself, what do I know of this standard? Very important. Your exam is such an exam or such a paper that ICAN would try as much as possible, even if it is not a full-fledged question that the standard will be on. They will want to, touch here, touch there. Now, the person that will pass this exam is not necessarily the person that knows the A to Z of all the standards. So when they mention a particular standard, there are certain basics that you should still know of that standard. You may not, if we go deeper, you may not be able to answer a tested question. Yeah, but if it is part of a question, you should still be able to pick up an understanding from there. And that is what I'm going to be hoping that when we start to look at the solution of this question, I'll be able to rely on your knowledge of IFRS 2, having done it with Mr. Washir, share-based payments, all right? So let's move on. So you have, let me just explain the question. What they are simply saying, or what they have said so far, is simply saying that, you know what, as part of our benevolence in this company, Omoge Nigeria PLC, for our directors, we give them share option, which will vest at a future date, meaning that that future date, they will have a right to exercise whether they want these shares. And if they do, rather than pay them, what we'll do is we'll give them the shares, all right? The shares will be theirs, all right? Now, this share of 400,000 will go to Adamu Salisu. Vesting date is June 2021. 1.2 million of shares will go to Chukwueze, which date? June 2023. If in the two instances they both exercise that right, all right? Now, what IFRS 2 says is that you should calculate, you spread the time between the grant dates. This is the grant date. Between this grant date and the vesting date, you are going to make up for the amount if they are exercised. So meaning I'm going to be recognizing an amount, I'll be accumulating an amount, I'll be recognizing it over the period until this June 2021. And it is still in the spirit of IFRS. Most of the things you do in standards, you must understand some things. They are just in the spirit of IFRS. When I say in the spirit of IFRS, what do I mean? This looks like, it looks like I'm making a provision, right? Yes, that's what it looks like. And that is what it is. It is probable that we will have to issue this number of shares to them on this date, in as much as they still remain in the company. If they are still meeting that condition, then I can go ahead and say I'm going to have an expense option, share option expense as at that day, as at the end of the reporting period, and recognize same amount on my equity. The same thing will happen to Chukwueze, like that. Like that is just me refreshing your understanding of IFRS 2. We'll get there. Now, the directors must be working. We've said that already. They said no directors have left the company since the issue of the share option. They will not leave when they know. And none are expected to leave before June 2023. There has been no indication from any of the directors. There is no intention to jackpot. There is no intention to go and establish their own business or anything. They are still fully, there's no indication from them at all to suggest that they will leave before that day. The options can be exercised on the first day of the month in which they vest, all right? Meaning that June 1, 2021, it can be exercised. And if it is June 1, 2021, it's not so different from May 31st, 2021. There's really no difference. It's what you do in accounting now. Balance brought down, balance carried forward. Balance brought down, balance carried down, or balance brought forward, balance carried forward. It's the same amount for those 2 days. All right. Let's move on. Now, in accordance with IFRS 2, like I mentioned of, an expense of 600,000 had been charged to profit in the year ended May 31st, 2020 in respect of the share option scheme. Now, let's play around this one. Sorry, let me share this. I thought I was sharing the question with us. Here I come again with the Word version. I want the PDF version. All right, okay. Now, this 600,000, is it possible for us to walk back and see how they got it? Yes, it is. The only issue here is that I don't know if they probably have any other one. All right, but if we were to calculate, we would have said 400,000, which is what will materialize. This one came as of 2019, all right, and it will vest 2021. Between 2019 and 2021, we have 2 accounting periods. We are going to have May 31st, 2020 and May 31st, 2021. 2 years, Abi? All right. So, under normal circumstance, what we should do is to say these 400,000 shares, if they were to be exercised, they would exercise at 4 naira, this value here, Abi? But then we have 2 periods, okay? We have 2 periods as of the beginning of 2020. As of June 1, 2020, we say we have 2 periods. So therefore, this is one of those periods. So I will recognize 1/2. And this will be 400,000 times 4, which is 1.6. Yeah. 1.6 divided by 2. Isn't it? Isn't it? Yeah. So we would recognize 800,000 ordinarily. But the question says 600,000. I don't know if the question, we are taking an extract. So they are not telling us everything about this company. But for the purpose of what we are doing, they made mention of 600,000. They said it has been charged to the profit in the year. In the year ended May 31st, 2020. And then in respect of the share option scheme, they said the cumulative expense for the 2 years ended May 31st, 2021 is 2.2 million. All right. Now, tax allowances arise. Very important. This thing now is speaking to tax base. So you must be careful around it. You must understand what they are saying there. They said tax allowances arise when the options are exercised and the tax allowance is based on the option's intrinsic value at the exercise date. The option's intrinsic value at the exercise date. Meaning that if I cannot calculate the option's intrinsic value, then I cannot possibly solve this question. I cannot possibly solve this question. It will be impossible. All right. So what do I want you to note here? What do I want us to note here before I go ahead and solve? Just to give you a background understanding, is that they were explicit enough around here to say tax allowances arise when the option. So for the purpose of tax, we will consider the option's intrinsic value. We are not going to consider the fact that you have made a deduction here. Whatever amount you have deducted here is not based on intrinsic value. This one is based on the exercise value. If they were to vest, it is based on the exercise. Now, what is the intrinsic value? The intrinsic value will be the difference between the market value of the options and the exercise value. Let's look at it. Let's look at it. Let's look at it. So let me go back to my Excel. Can you see my Excel? Can you see my Excel? Is that what you are seeing on the screen now? All right, so let's move on. First thing first, what is the requirement? The requirement says I should evaluate the tax, the deferred tax implication of the share option for the year ended May 31st, 2020 and May 31st, 2021. So let's start with the first year, May 2020. All right. So what is the market value? In this instance, let's go back to the question. We're told the price of the company's share at May 31st is 8 naira per share. At May 31, 2020 was 8 naira 50 kobo. All right. Now, for Adamu Salisu, grant date was June 1, 2019. All right. Meaning this one had been in place. Only the 400,000 options had been in place as of 31st May 2020. I don't know if you understand what I'm saying. As of May 31st May 2020, we didn't have the option of 1.2 million. The only thing we have was 400,000. All right. So the market value for this one will be those 400,000 shares. Sorry, it's dark here. Multiplied by 8.5. But then don't forget, the vesting date is 1 year in front, meaning that as of the end of year end of 2020, there is still 1 year left before the vesting date, June 2021, which they say it can be the first day in June. And I have said the interpretation of that is that we can take it to be May 31st, 2021. So if that is the case, then we have 1 year left out of the 2 years. Between 2019 and 2021, there are 2 years. So I will do the proration of 1/2 on that basis. Right? So therefore, on that basis, I'll take this calculation here and say this is the market value. All right, if those shares were vested. Why am I doing this calculation? I'm doing this calculation because my tax base is on intrinsic value. Now, what is the exercise value? The exercise value will be almost like this, except that my focus will be on the exercise value, exercise price, which is how much? 4 naira. Exercise price is 4 naira. So what do? I'll simply say this is going to form my calculation of the exercise value. This gave me 800,000, all right, which is what I calculated the other time. Now, this is the intrinsic value that I was referring to. Now, this intrinsic value is going to form the tax base. This intrinsic value is going to do what? Is going to form the tax base, because I can go back and read what they said again. You must be able to determine when they start to mention anything tax allowance, pay attention there. That is where you will find your tax base. They said tax allowances arise when the options are exercised, and the tax allowance is based on the options intrinsic value at the exercise date. So what is probable here as of the end of 2020 is that the tax base, the intrinsic value is 900,000. That is our estimation, 900,000. All right. Now, with regards to, somebody will now say, what of the cumulative share option expense? Don't forget, they have a share option expense to the tune of, according to the question, 600,000. To the tune of 600,000. All right. To the tune of 600,000. Now, with regards to this, what we are looking at here is this. When the tax authorities come, they have told us in the question, this is what they are going to consider for tax allowance. All right. This will not be considered, meaning that if I am to estimate the future tax based on this number, my tax rate is 30%. All right. I will say as of this date, tax should be 900,000 times 30%, 270,000 naira. I will not get this now. Why? Because I will only get it when the rights are exercised. Don't forget, when the rights are exercised. However, in the current period, this expense in the current period will not be considered, meaning that they will deduct it. And the tax rate here also is 30%. This will equal this amount multiplied by 30%. So what's the interpretation of this? Currently, this will be a situation where I will be taxed on 600,000 today, but then I know that the intrinsic value is what they are going to use in the future. And this intrinsic value is 900,000. I have an allowance of 270,000 in the future. This is an asset to me. This is going to be, you can call it a deductible temporary difference arising as a result of this. Are you getting what I'm saying? Why am I saying this is that as of now, I will not be granted this capital allowance, but I will be granted this capital allowance in the future. So when they want to give me this capital allowance as of now, I don't have a carrying amount that they will use for tax purpose for it. It is what I will get in the future. So my tax base here is 0, even though the intrinsic value is there as 900,000. So this is a deductible temporary difference in the future. This 900,000. Now this is the deferred tax assets that I have, 270,000. However, currently, because this will not be an allowable expense, in respect to this share option, they will give me capital allowance. So they are going to add back this as a taxable profit. So this will go back, this amount, 600,000, will go back as a taxable profit. I will be charged in the current year. It will form part of what I will be charged in my current tax, 180,000 naira. So eventually, this is what I would rather do. I will say deferred tax assets this amount will come here. Deferred tax assets to be a debit. How much? 270,000. All right. then I'm going to have to credit my current tax liabilities. How much? 180,000. Now, the remaining 90,000, where does this go? We are talking about a prior year. Ordinarily, you should go to my tax. It should be a reduction on my tax expense. So I'll take it to, this is going to reduce my retained earnings. I mean, increase my retained earnings because you are using it to reduce your tax. So you have a credit of 270, an expense of 180. This should be here, and this should be credits. So this is going to be the treatment for year 2020. This will be the treatment for year 2020. And when we come to May 2021, I'll do the same thing I did here. The only difference now will be this. The only difference now will be this. For this number of shares, when we did it in 2020, we were looking forward to 1 year, Abi. Now that 1 year has come. That 1 year is 2021. All right. But it is no longer the only share options I have. Don't forget that I still have the one for Chukwueze of 1.2 million. 1.2 million. 1.2 million. The excess, the market value rather. And again, as of May 31, 2021, the market value is now 8 naira. So I need to edit this one. 8 naira. So this one too is 8. Now, when was this one vested? It was vested, it was granted 2020. June 1, 2020. So the first year is where we are looking at now. Out of how many years? Out of 3 years. From 2020 to 2021, 1 year. 2021 to 2022, 2 years. 2022 to 2023, making it 3 years. But now I'm considering the first year. So out of the 3 years, I'm looking at 1 year now. So it will be 1/3. It's not so different from what I did here. So I'm counting down the first year out of 3 years. All right, this is what I'm going to use here. So I'm going to substitute that calculation here with this value now.
All right, Mr. Abiodun, what about the number of directors? Are we not going to consider that?
There are 2 directors, Abi.
Yes, there are 2.
So are you saying the number of directors should affect our calculation? It shouldn't.
That was what I think that was what.
It is the number of options that matter. So a question may tell you, look at it. Instead of telling you the number of options, they can tell you you have 5 directors. All right. And they tell you that each one of them they are entitled to how many? Let's say, how many is this? 10,000. So for me to determine the number of options, I will now need to say 5 multiplied by this 10. And I will get 50,000 options. But this question did not tell you each director. They told you what is belonging to each of the directors. They specifically mentioned the director and the number of options they have. They don't have equal number of options. Is it clear now?
Okay.
Is it clear? You only said okay.
So what you're trying to say is that whenever we are giving options, that's when we consider that.
Yes.
Okay.
Yes. Now, in calculating this one too, I have come to the year where it should be exercised. So I'm no longer prorating by 1/2. All right. So the total amount I should have should now be this 400,000 times 4. All right. The total number of equity I recognize is now 1.6 million. Okay. I would have done in my expense additional 1/2 and taking it to equity. So everything will now be totaling now 1.6 million naira. Okay. However, for the one of 1.2, that one is day, is still new. I think 1.2 is not complete yet. And the exercise price is 5 naira. Like I mentioned, you are still in the first year. So it's still 1/3. All right. So I'm going to input this as my calculation of the exercise value. And then we have 3.6. So the difference again is going to form our intrinsic value, which is the tax base. All right. I said as of here, we're going to have we still have the question still did not mention that the options have been exercised. So for the purpose of this, your tax base is still going to be in the future. We will say this is a deductible temporary difference, and the tax rate will be applied on it. So it's now 840. But mind you, you have recognized 270 for this purpose before in the prior year. So I'll say recognized in 2020 was how much? I'm going to deduct this 270. So what we have now is 570. So this would be the movement that we'll recognize in 2021. This amount here. Okay. Now in this same 2021, they told us that we now have can't see my screen. I mean, my keyboard is very low. They told us we now have, instead of 600,000, what we have now is, let me check again. The cumulative 2.2 million. 2.2 million is what we now have. All right. That's what we have now as our cumulative. But don't forget, this is cumulative. So it means that what they would have charged to P&L, you will need to minus this 600,000. I don't know if you get what I'm saying. Cumulative, meaning this is what you have in your SOFP, 2.2. is what you have in your SOFP. What would have gone to your P or L? You recognize 600 before. The movement is what would have gone to your P&L to form part of your taxable profit. All right. So in 2021, this 480 will form part of your current tax in that year. So I'm going to go back up here and bring this same posting, and I'll say in the current year, my deferred tax movement is 570. The current tax liability will increase by 480, and I'm still going to credit retained earnings with 90,000. And that is how we're going to treat the question. Now, if you check their solution, they said deferred tax liability. I have treated it as current tax. The reason I have done that is because they will not recognize. I believe that with respect to, it seems the question already, man, it's not, don't confuse yourself, it's not deferred tax. It's current tax. The numbers we have will be the same, but just the nomenclature will be different. And the simple explanation for that is that in that current year, or in those years, they have already told us in the question that tax allowances will be granted when the right is exercised. So the reason we are having a deferred tax asset is that that allowance, we can't have it in 2020 yet when we did the calculation for 2020. And in 2021, we can't have it yet because we have not been told. The question did not tell us that the right has been exercised. So what we will say is that we have an allowance, but it's in the future. Now, based on the calculation, based on what will be the tax base in that year, the tax base will be the intrinsic value. So what am I going to take as my deferred tax asset? I am going to take that intrinsic value and calculate my tax rate on it. I don't have it now. I won't have that allowance now, but it's a future deduction I can make. So I will say I have a deferred tax asset. All right, but that one did not concern the tax authority. What concerns the tax authority in 2020 is that I can see that you have an expense, you have deducted from your income, your share option expense. What's the name of the company? Omage PLC. We will come back to this when those rights have been exercised. As far as they have not been exercised now, the only thing I can recognize is when they are exercised. So therefore, this 600,000 will form part of what I am going to tax. So what are they going to do? They will add it back to taxable profit. That is why I said it is the current tax liability. It is not a deferred tax liability. Is that understood? Is that understood? Are we in this class? Is that understood? All right, I'm going to move on to the next year.
Yes, sir, understood.
Thank you very much. In the next year, we calculated the intrinsic value again. The intrinsic value has gone up, but don't forget that you had recognized an amount in 2020. So when you calculate your deferred tax asset, you need to recognize the movement. It is the movement. Now that 840,000 is going to be sitting in your SOF, but you had an amount in the previous year, 270,000, right? Was it 270? Yeah, 270,000 in the previous year. So when you now want to treat it, it is the movement that will go to P&L, and then that will sum up to that 270 and form 840. The same thing will occur when you get to taxable profit for the year. Your taxable profit for the year, the taxman will come again, will say, I am seeing that you have done share option expense again. For the purpose of share option again, I am only going to recognize the allowance when it has been exercised. Has it been exercised? No, it has not been exercised. So therefore, that's your expense. I am going to add it back to taxable profit. And in doing so, what they are going to do is that they are going to say, oh, I can see that you have 2.2, the accumulation of the tax expense on your liability side. However, the movement is what I am interested in. What did you charge your expense? You used to have 600,000 before, now you have 2.2. Therefore, you must have taken how much? 1.6 million to the POL. So you do 30% of that, and then we brought 480. So that 480 is going to be a current tax liability. It's not a deferred tax liability, like you say. I saw their solution, I looked at it. I was not in tune with the explanation. It was a bit, it may be hard for you to understand. That's why I'm taking my time to explain it now. So it's a current tax liability. It's going to be added back to the taxable profit. All right. So when you have done this, you now have your tax liability going for 480. You have your deferred tax asset 570. So the difference, because that movement is forming part of your income tax, that 90,000 that goes to your retained earnings. All right. Okay. So this is where I'm going to end it for today. You have an assignment. Quite simple. I just want to see your abilities to do them. Don't be too tempted by the fact that we have written where the questions are coming from. The two questions look alike. They're almost the same. So you can go for it. They are FR questions anyway, but you can go for it. These questions, I have looked at it. If they want to be nice, they can set it for CR as well. You can as well go ahead and set it for CR. All right. So I'm going to do the solutions, but I will await your own attempt first. So do question 2 and question 3. Let me give you hints on how to go about question. Don't stress yourself. If you go and look at the solution for question 2, you may be more confused. So just try and attempt it on your own. What I want you to pay attention to, me, I don't mark. Okay, I've never given an assignment that anybody did in this class. I think I have questions for us during this holiday. I'm making up something for us. So I don't mark. Well, the biggest mistake you make is to say, I couldn't finish it, or I'm not sure I know it, therefore I'll not attempt it. Attempt it. It is from there I'll see what you've done, and I'll be able to make comments. I'll be able to tell you why you should have done this, or a way you could have done it better. So just attempt question 2. In terms of how to go about it, question 2 is really testing PPE. And if you read the question, they are giving you the carrying amount for the various assets. If you have the carrying amount of an asset, to do the following year carrying amount should not be added. I'm just going to deduct the depreciation from the carrying amount, and I'll get the next year carrying amount. And I'm going to add, they are also giving me, don't worry, go and read it, you will see that it's not hard. They're also giving me the basis for tax computation, how they are going to deduct allowances. They say tax deductible is here. In the first year it will be 50%, second year is 30%, third year is 20%. So for the purpose of taxation, I will deduct the tax depreciation, and I will have my tax base. The difference between the carrying amount and the tax base will tell me whether it is deductible, temporary difference, or it is taxable temporary. Just go and look at it. Just go and look at it. I know some of us will probably have solved it when we were preparing for FR. All right. Do we have any questions based on what we've done so far in this class today? All right. If there are none, what is left for me is to keep testing you. So like I said, I'm preparing questions for us, 1, 2, 3, 4 questions, just to go and brainstorm and practice. So our next topic is going to be a joint class. I don't know if Sunday can be possible. I'll come back after I've spoken with the FR students. If you can give me Sunday evening, I wouldn't mind, so that we can complete IAS 33. But if that is not the case, see you on Friday, next week Friday, to complete IAS 33. And that will be that. All right, thank you, everybody. Bye.
Sorry, sir. I have a question.
Go ahead, please.
Okay, so concerning this deferred tax asset 27C, which if you look, there's a difference of, if you compute the difference with the current tax liabilities, 90,000 credited to retained earnings. Is it that we credit retained earnings with 90,000 for the 3 years?
For the 3 years? No, don't get it wrong. So your income tax expense is what is this 90,000. How you would have calculated it is to say, my current tax, your current tax, I told you that your income tax expense, let me start like that, is made up of 2 things. Your current tax plus the movement of your deferred tax. Now, the movement of your deferred tax will be an addition to this current tax if it is a deferred tax liability. So if I have 50,000, okay, let me use the same example. Current tax had increased by 180,000. All right. If this was a deferred tax liability, we would have also increased it by 270,000. All right. And this would have been how much? I think it's 170. And this would have been 450,000. But what you have as your deferred tax is a deferred tax asset. All right. Your deferred tax asset will not increase your liability. Instead, it will reduce it. Now, when I reduce 180 by 270, you see that the final answer I have is minus 90. So altogether, my deferred tax assets or tax credit, no, sorry, I don't have an income tax expense at the end of the day. What I have is an income tax credit. You know why? Because rather than this 90,000 in reducing my profit, what it will do is that it will increase my profit. Why? Because my movement of the deferred tax is higher than my expense. I don't know if you understand what I'm saying.
So that means that at the point of exercise of the option, we'll be able to claim 90,000.
We'll be able to know what you will be laying claim to as of this 2020. What you have calculated as you'll be laying claim to is 270. If the market price remain, if the market price were to be 8 naira, how much that? 808.50 here. Eh? See, your tax base is 900,000. Do you understand? So the tax allowance they would have given you for the purpose of tax is 30%, they would have given you 270,000. Do you understand what I'm saying? They would have deducted 270,000 from your taxable profit. And that's what I'm now saying, that when you leave 2020 and you come to 2021, your tax base here is 2.8 million now. your deferred tax is 840,000. Meaning if these two were exercised by the end of 2021, the allowance you would have been given is 840,000. Now, the reason we did not recognize 840,000 and recognize 570 is because we had earlier recognized on our SOFP, you can see 270 there already. And we had earlier recognized 270,000. So if our deferred tax is 840, the allowance that we can claim is 840. We only pass the difference to make up that 840. Now come here. You see, my deferred tax, I am going to debit 570. My current income tax expense is 480. So if it is 480, my liability there increases by 480,000. The only reason why I am crediting retained earnings, meaning that I am saying that I don't have a tax expense at the end, because my tax expense is lower than the movement of my deferred tax. If I bring the same scenario I have up here, if I bring that same scenario, if I bring it down here, what I will be saying is this. I will be saying that my current tax liability is 480,000, but I have a deferred tax. This is just accounting computation. All right. In that year, when FRS come, they will collect their 480. But you have done your own working, and you have seen that I will have claim to 840,000 in the future. So as a result, and I already recognized 270 from it. So it is that 570 I'm now recognizing now. And I'm now telling them that I have an income tax credit of 90,000. That credit is just the difference between the current tax expense and the movement of the deferred tax. That is what's giving birth to that 90. So I don't know if you have ever seen it before. I made mention of it when I was teaching you on Sunday, that it is possible that you are looking at an audited financial statement of the company, and you are saying that when they got to income tax, instead of expense, what they wrote is credit. In such a case, it will not reduce their bottom line. It is going to increase it. And I have an example like that. I said, I think I mentioned it. I said, I know of a company. One of the companies I work with is a group structure. One of the affiliates that I worked on their account, they have this kind of scenario. It's not that they did not have current tax expense. They have. When tax consultants brought, in fact, it was KPMG that worked on it. So they brought it, we looked at it, we also verified. Said, okay, we are okay with this. That's the current tax. But when they will submit later during the day, the deferred tax, we add a deferred tax asset. Why? Because that company had losses in the prior year. They have, what is it called? Is it balance? I can't remember. Is it balance allowable or something like that? I can't remember. But it has to do with loss relief. And it was not totally used. So they brought it into the current period. By the time they finished the deferred tax computation, the movement of the deferred tax computation led us to a tax credit. It led us to, a tax asset. So when you now come and add that tax asset, if I was on worked on it, it came down to tax credit. When I saw it, I said, let me look at the deferred tax computation. And I spoke with the tax consultants. They have so calculated, they are okay. And I looked at it from what they said, it's true. So the only question they were asking me, or what the discussion turned to was, if you feel that you will not have profit that you can use that tax relief against in the future, IAS 12 says only recognize to the tune. And I looked at the amount is something that the company is already making profit. That made profit for like 2 years. This is the last year we can use that relief. Let's use it. And we moved on. So the long and short of it is that this income tax credit is going to increase your profit for the year. It will not reduce it. So I'm sure that year, this must have been one or two. A candidate may have even gotten the question correctly and be afraid when it got to a point where you see that I'm going to credit P&L and it's tax. Don't be afraid. It's possible. Is it clear, Mr. Pascal?
Okay, sir. So I'm understanding it now. So it means that their current tax is 480. They have a deferred tax asset of 570. And to
Exactly.
balance the equation, accounting equation, the credit retains earnings 90,000.
Yes.
So, but
If it
based
was
on the
even the
question,
current year,
they
if it
cannot
was even the
exercise.
current year, sorry, if it was even the current year, instead of saying retained earnings, actually P&L, it's going to their P&L, not retained earnings. The
Sorry, I
reason
didn't
we
hear
say
that.
retained earnings, if it was even the current year, we are looking at it as though this is not the current year. That's why I say retained earnings. If it was in the current year, it's going to their income tax expense, their P&L. Do you understand now?
Okay, sir.
All right, go ahead. Let me hear your question now.
Okay, so I'm saying that if we credit their either retained earnings or their PRL with 90,000, it means that based on the question scenario now, that they cannot claim that deferred tax asset till the option is exercised, right?
Exactly.
So they will have to still pay the tax of 480.
God bless you. That's exactly what I'm saying. That's if there is no distortion between them and the tax authority, they will go and pay this 480. They will pay this 480, that's their current tax. They will go and pay it. So it is in the future that you will now come and say, oh, the allowance is now being granted them. And the reason I've said it, the reason you recognize any asset is about recoverability. One of the reasons you recognize assets, it must be that statement you were used to make. Is it probable, anytime you mention asset, is it probable that the economic benefit will flow to the entity? So it now depends on how it's going to flow. In the case of tax assets, how is the economic benefit supposed to flow to the entity? It is supposed to flow in that in the future, we can use this amount, or this amount will reduce our tax liability. Can we measure that amount? We have measured it. Is it probable? It is probable. Then we go ahead and recognize that tax liability. If it is loss relief, it's the same thing. The standard said, if you are sure that you will make profits, that let's say your loss relief is for 2 years. Say, if you make losses, so you can use it to reduce your tax liability. Okay. Whenever I have a tax liability, an amount I'm supposed to pay as tax, I can use the tax loss to reduce it for 2 years. If it is not probable that I will make profit in the next 2 years, there's no point recognizing an asset. I shouldn't recognize the asset because it is looking like I will make losses in the next 2 years, and I will not have any profit that I want to use that loss against. So, all right, I want to believe that the more questions we solve, the more we understand. That is our test questions. And as I'm saying, those 2 FR questions are in the questions. You can go ahead and try them. If you have any problem, text me or call me. We'll discuss it together, and that should be that. So I booked 2 hours for this class. We've come to the end of the class, except we have any other question. Mr. Pascal, any other question?